Hey guys, and welcome back to Box Mining. Now, with this video, we're talking about derivatives trading on a decentralized platform. And this is actually something that is one of the biggest application use cases of decentralization and of decentralized finance. Everyone wants to trade, everyone wants to have additional trading tools, and hence derivatives. So today we have Injective protocol. We have the co-founder, Eric Chen, coming in today, and he's going to share a few provocative thoughts like why are derivatives cooler than just normal trading, and a lot of detail about the platform Injective protocol as well. So Eric, welcome to the channel.
Hey, Michael. Thanks so much for having me.
I mean, normally, everyone coming onto the channel, we ask them a little bit about how they got started. So kind of what led you to this point? What led you to the passion of getting into DeFi and derivatives trading?
I would say that I always had a trading background by studying finance. But my foray into crypto really started in college when we kind of realized that electricity was free. And we set up this giant mining rig and trying to mine Ethereum. At one point, we kind of I think we tripped the breaker for the entire dorm room floor. And I'm pretty sure that was the inspiration for the show Billions. And yeah, I think that was the first time I got really serious about looking into crypto.
Nice. It's like such a similar background as well. I pretty much had the exact same story with mining in my own dorm and tripping, not the entire building. I'm not that, that aggressive, but we got my side of the dorm. So anyway, starting with this derivatives trading side of things, right? Mm-hmm. So, you started off when we talked and you said, derivatives are cooler than normal trading. I mean, why led you to that assessment? I mean, it's one of the tools, I would agree, but why is it cooler?
I think in general, especially from a traditional markets perspective, it's such a versatile tool. So you can use it to hedge against price movements. And as a matter of fact, that's actually the number one use case rather than going 100x leverage on BitMEX. And then there are a lot of other parts. Obviously, there are leverage exposure. There's also, accessing to some of the hard to trade assets. That's why there are commodity futures. That's why there are treasury bond futures and stuff like that. And I would say that from engineering perspective, it's actually kind of like a financial take on the shared mutable state problem. Because essentially for a spot market, it's being frequently traded so much, especially if you look at kind of the quantity available or being liquid. So if there's a huge demand, but there's not enough supply, and yet the underlying or the equity is being priced properly, you're really having this rush of liquidity where there's nowhere to access this type of asset. So essentially what's gonna happen is that's why people will start pointing out derivatives. It's kind of like an expansion of the existing spot market.
I think that's kind of interesting because, I mean, definitely derivatives trading gets a bad rep from over-leveraged positions. So, yeah, so 100x it's popular, all right? And I've seen, a lot of YouTubers talk about it, encouraging people to use it, and then people get liquidated and then people get angry, right? So that's one side of the coin. But the other side you're talking about is obviously it's a very powerful tool for for people who want to take a particular short position if they think a value is going down, so they have the ability to take short. And then, of course, talking about how the spot and the derivatives dynamics plays out. So talking about that, right? So we've had some derivatives markets before. I mean, you mentioned BitMEX, and then we have FTX, and then we have Deribit and all that stuff. Why go decentralized?
Yeah, that's actually a really great question. So there are actually a few reasons to be fully decentralized when you're trying to launch a derivatives exchange. And obviously there are very clear benefits to being centralized as well. So let me start off by talking about the cons of building a decentralized derivatives exchange and why I'm so excited about building out the fully decentralized stack for this type of platform. So first of all, decentralized derivatives are very slow. Obviously, settlement has to be constrained by the block time of Ethereum. So that's why for BitMEX or for Binance Futures, for FTX, they serve as a really strong central point of liquidity for the most frequently traded assets. They can support the highest possible throughput. They can take over the most popular market out there. But one thing that they can't do too properly is to explore, innovate, and really just to find out the next big thing in the space of the market. So there are two reasons why they won't do that. Number one is that there's just no incentive. They are one of the bigger folks. The cost of deploying a new market, the cost of seeing like a market failing or losing traction is just way too much to worth their time, basically. And really, the second part is about regulation. What if this is violating a lot of CFTC rules? What if this is kind of going against some of the laws and regulations in some of the local jurisdictions? So that's why it's so exciting to be in general the DeFi space and the decentralized derivative space. Is that first of all, DeFi is has a lot lower leverage, surprisingly, than the traditional centralized derivatives. You see, like on DYDX, and max leverage is only 20x. I'm sure most of the derivatives in the space right now wouldn't try to go over that number. And also for just in general for like lending and also going leverage on DYDX margin, they won't let you go past 5x. So they're basically building up this decentralized stack in a relatively safer manner, especially considering that because it's being traded so slowly, because there are so many risk factors, they have to kind of keep themselves restrained. And this actually create a lot more possibilities that, hey, like if I want to create a new market, people are already used to markets with somewhat low leverage. People are already used to markets with somewhat lower liquidity in the beginning, and people are willing to take a risk to understand those markets more and to, extract as much value from it, or just in general, people call it making money from it in the future. I think a really good kind of trend that we saw before or even currently is just farming. People stake in and participating in pools and then get token in return as part of their reward, and also that will factor into their APY. And I think if without all these token incentives, people might not necessarily have participated in a lot of these DeFi protocols. As a matter of fact, I didn't really participate that much within lending pools back then because the rate was just not as good as some of the centralized ones.
Now, my biggest question is, can people establish their own pairs, or is that still very centralized in some manner on Injective?
Yeah, so our goal from start to the end is always creating the platform for it, essentially building the fundamental infrastructure so that you can do whatever you want on top of us. If, let's say, I'm a financial engineer and I just came up with this great idea, I want to track the yield and sometimes even go leverage on these lending pools, I could just basically create an index for it, either referencing from some of the decentralized Oracle solutions or setting up like a centralized Oracle solution, and then implement the Oracle interface contract on a futures protocol. If I'm an ETH holder and I hold some USDT, or generally USDT is probably the most liquid stablecoin, or USDC in some cases, I immediately start depositing this token into our PegZone contract. So essentially that's the contract that stores and holds all the tokens that are being deposited into our own chain. The watchers that are monitoring that specific contract for all the deposit coming in and out. Once they saw the asset coming in and landing in a contract and locked up, they'll just start minting the mirror token basically on top of our own chain. And basically then you can use this USDT on top of our Injective chain to trade and establish a leverage position, either going long or going short.
Okay, so it's kind of like it's a bridging process. I mean, a normal user wouldn't really feel it that much. So they have the assets. So you're saying you're preferring a sort of stable coin, so USDT, you deposit it into a contract. So click button, deposit, and then it'll appear on the other side on the Injective chain side. So once you're on Injective chain, you're using it almost like a normal derivatives exchange. You basically have an order book, and then you can pow, and click buttons and start placing orders, right?
Exactly, but it's actually simpler than you thought. Essentially, how it looks like is that we could have like a website that shows that, hey, deposit into this contract. And then as soon as you deposit into that contract, I would say after like generally how long a Ethereum transaction would take, it'll just start popping up on our own chain. And you use the same wallet, you just connect to a different RPC endpoint and use the same signature. So it's still your money at the end of the day.
Oh, okay, got it. So it's actually quite... it doesn't require multiple plugins or anything. So it's kind of almost a more seamless experience for that, right?
Yep, that's a goal. And so basically from that point on, you deposit the token into the derivative contract. You open like you can use from like the account number one, or you can open like a sub account, and then you just establish a long position.
Got it. So obviously we've used these exchanges before, and they're relying on centralized order matching and transactions. And we've seen that on the flip side, on the decentralized exchange side, unfortunately, the fees, the gas fees get quite high. So how did you design around that to kind of mitigate these problems?
Yeah, so we actually don't have gas fees. Obviously, aside from the deposit and withdrawal part. So the way we designed this is actually, we actually made some changes to the kind of like the core consensus and basically some of the components within the Cosmos SDK, is that we took out part of the gas elements. So whenever you place a trade, whenever you take a trade off of the order book, or whenever you settle a trade, the gas is actually being fronted by the nodes or the quote unquote relayers within our protocol, which is just nodes really. And they have a really strong incentive to do that because you're essentially entering into like a fee sharing agreement with them. So basically, whenever I interact with a node, I'm a trader. I obviously have to submit an order somewhere. I can submit it to some of the more exposed nodes out there, and I can just within my order parameters, I just sign over his address. So 40% of the fee would go to his address. But the caveat is that if I don't sign it over anyone, I still pay the full fee. So it's honestly just kind of like a altruistic move to like, share more of the value to the greater ecosystem and creating this kind of like incentive mechanism. So there's a huge incentive for their nodes to kind of front the gas fee for you in a sense. And obviously by being proof of stake, by having like a really application specific infrastructure for trading, the general gas fee is just going to be an order of magnitude higher than Ethereum.
Cool. So you create this ecosystem, all right? So let's say once this is running, obviously you got a full derivatives exchange, and we know that this market is very hot. There's a huge amount of volume there. So where does the token come in? So how does that accrue value for the ecosystem, et cetera?
Yeah. So one of the biggest part is obviously a proof of stake security. So you have to roll over the validator, and you have to make sure that the incentive aligns well for the validator because they're performing so many tasks and they're kind of securing the entire network. Mm-hmm. So we have like a fixed inflation that decreases over time, but never goes to zero for a validator. Mm-hmm. And this way it'll keep the incentive very well aligned. The second part is mainly the deflationary part. So we want to make sure that the validator get even more value from participating in the network, and just in general, like all the ecosystem participants / token holders, by essentially hosting a monthly auction and opening up bids for all of our exchange fee that we've aggregated on chain, and we'll just pick like the highest INJ bid and then just burn it, and just burn the INJ that we get. Obviously, this is completely done on chain. This is completely permissionless and decentralized.
Got it. So it's all to do with fees. I mean, like we've seen how much fees are generated. So generating value and then burning the fees on the process. So you have this network set up. Now, in terms of trading, all right. So as an end user, let's say I want to place, like I was saying, I was placing a trade, but we see some various mechanisms in the centralized exchange, which kind of make sure that I'm not over leveraged, and then also at the same time making sure that the price is relatively close to the spot price. So I guess this is two questions. So let's start with the first one, which is like, how do I do leverage on the exchange? Is there leverage options for the derivative contracts?
Yeah, of course. So basically, there's essentially a collateral ratio that you have to maintain. So there's obviously the initial margin, and there's obviously the maintenance margin. The initial margin is basically the maximum amount of leverage that you can go theoretically, and the maintenance margin is basically if you go below that, you're just liquidating. So obviously, in order to make sure that the contract trading price and also the index price stays mainly in parity, there are two ways, right? Number one, we just use the same funding rate for most of the major perp markets. Generally, we actually have a really interesting mechanism where since our order book data is on-chain, we actually don't need an oracle for it. So a lot of people actually get a huge headache around, how do we calculate the funding rate? How do we make sure that, we get the most fair, we get a more decentralized solution to, and avoid using two oracles like DYDX's case. Whereas for our case, it's really natural because the order book data is on chain, so we don't really have to worry about it. So that's just the general ways I think that most derivatives markets and most of part markets use to make sure that the futures price trade at around the same as the underlying.
Got it. Because I think that's the key here, where the futures and the derivatives, they don't hold the underlying assets, so it's a trading market. So we've seen that on FTX, where like they charge an hourly funding rate. So is it going to be similar for you guys?
Yeah, we're actually testing both for our testnet that's coming out very soon. Mm-hmm. So I'm very excited to learn. Basically, we could do all of the unit tests and simulation possible, but I'm really excited to see when there's a stochastic behavior coming from the general participants, how is the market going to behave? Because no real money is at stake, and that's exactly what we're looking for. If you have real money at the stake, you can't really monitor all the black swan events because obviously things don't happen that often. But if no real money is at stake, we can actually look at the behavior for some of the extreme cases and just see, what are some of the safer assumptions we can make, and what are some of the edge cases that we used to have to be accounted for, but now we don't have to worry about it too much.
So right now you're at the test phase, right? So you're testing for all these edge cases and trying to do the tests. So what's the roadmap like for the product launch and everything?
Within a few days, actually, you guys can start trying now for the trading competition. So essentially, that's the interface where most of the traders are going to interact with. You can trade most of the markets out there. We'll try to make sure that the markets we ended up deploying is timely and also relevant, so that you guys are actually interested. And then it will run for, I would say, around a month at most. Afterwards, we'll start doing the incentivized staking. So the incentivized staking is that it allows you to create like a simulated return by participating within the consensus of the testnet. The point of that is so that we can actually get the proper slashing condition and monitoring, like, hey, all of our stakers ended up being AWS. Should we worry about that? So that kind of gave us a really clear picture about like how we should go about mainnet. And obviously in parallel with the testnet, we're also going to do most of the auditing. And yeah, after that, it's mainnet time.
Got it. Nice. Yeah. So you have this process set up. Obviously, to get participating, I want to say congratulations on Binance as well. So you guys are on Binance Launchpad coming up. How else can people participate? So what's kind of the tokenomics of that right now?
Yeah, there are actually so many ways, even before we launch our mainnet. So before we launch our mainnet, there's going to be trading competition, which the reward are all going to be done in our native token. And we actually thought about launching a trading competition before the launchpad, I would say around mid-August or so, but we actually had to delay it because we realized that in the age of farming, people don't really care about cash.
That's true.
Yeah. So we actually had to kind of like hold the curtain back a little bit and launch a trading competition, essentially with the token, so that people actually care more about it. Basically, after that, there's going to be the incentivized staking. And the incentivized staking is that we're going to take a snapshot of everyone's balance. And from this point on, that's your assumed balance. And you can use that balance to, delegate the staking pools, kind of be a validator yourself, or just in general, don't do anything with it. But by participating in the staking pool, by becoming a validator and joining the right validator, actually, you can actually make simulated return that's pretty much similar, if not higher, than the actual mainnet return. And this is really valuable to us because this way we can know, how do we go about setting up the slashing condition that's never been really tested before, because rarely we see validators who are also assuming the responsibility as like a peg zone operator. So yeah, that's what I'm really excited about personally. And then after the mainnet, there are so many things to be, there are so many ways for you to kind of get our token from, essentially. Number one is that we're going to have liquidity mining. We actually have a daily distribution of tokens. And in order for you to be eligible for that pool of token, essentially we calculate how much of that pool you get by the filled bank orders. So if you place a make order and it got filled, you essentially earn like a ticket. And obviously this depends on the market. This depends on, what are the eligible markets in general, what are the stablecoin. But we have a pretty fair mechanism to just calculate that because we can just go by stablecoins. And basically the more filled make order you contribute to the market, the more of the token that you get. So this is essentially like a competition for liquidity because most of the people want to provide, the best possible spread in order to capture the filled make order. So this is what I'm really excited about as well.
And that as well as that, if people want to find out more about the project in terms of information, what's the best place to look?
Yeah. So basically our Telegram group, our CMs are super active. It's called @join_injective. I think that's a really good place to start. Basically, if you don't know where to start, usually that's a really good place to talk to CMs and get most of the information kind of delivered to you. And then generally our website has a lot of information just covering the basics. And if you really want to dive really deep down the weeds, there's actually docs.injectiveprotocol.com, where it's essentially our developer documentation. It's almost like a knowledge base for most of the public material that we have.
We'll leave the links down below. So Telegram, first of all, and then website, and then docs if you're really hardcore. So I think that's pretty much wrapping up our interview, Eric. So thank you, Eric, so much for coming in today. I hope the platform goes well. There's definitely a lot of action in the derivatives front, and being on your own blockchain with no trading fees. I think that's kind of the appeal here, right? You want to trade on a DEX, but you don't want to pay fees. And I really think that this could take the next leap forward. So I'm really excited to see more, and I hope to bring you on in the future to tell us a little bit more about how everything's going, and of course to show us the platform as well.
Yeah, very excited to, and honestly, really can't wait to unveil the trading competition.
Awesome. Thanks, man.